Welcome to episode 37 of the Minds Capital podcast, the show devoted to the growing world of entrepreneurial private equity and independent sponsorship. I'm Will Smith, here with my partner in Minds Capital, Nicholas James. We are without our third partner, Max Lummis, today, but Max will be returning next week. Today's conversation is with Ryan Sullivan of North Park Group. I know Ryan from his appearance on Acquiring Minds last year, Acquiring Minds, my other podcast. And the fact that he makes sense for both podcasts, Acquiring Minds focused on ETA, this podcast focused on independent sponsorship, really speaks to the fact that what North Park Group is doesn't slot neatly into either one. It has a really unusual structure that takes the best of the SBA style ETA model, the best of the independent sponsorship model, the best even of the Holdco model. It's really quite unique. What was your impression, Nicholas, of Ryan and the North Park Group?
Well, first of all, I would say we have the privilege of meeting a lot of great podcast guests, and they are always amazing when we do pre-calls with them. And then usually still amazing when we record, but maybe a notch more tentative or hesitant when we actually press the recording button. With Ryan, I would say we had a very good pre-call, and then he did just an outstanding job. He was truly excellent once we hit the record button. He had a high pace, he was opinionated, he was very specific, and he answered the question and only the question as we progressed through this interview. So it was formidable, and I learned a lot, and I really enjoyed it. As far as my takeaways, more than anything, he presents North Park as a fully baked concept. And there are many examples throughout the whole episode, but it's fully baked from the sense that it's thought through, it's perceptive on where they're going, it's very cognizant of their weaknesses and strengths. And some examples would be, they have a waitlist of investors. The investors are screened by investors who are particular for their use case, which is indefinite holds with a particular carry structure in PG-oriented deals. They have a whole model around employee welfare, not only at the GP level, where each operating partner gets a stake in the GP as well as the deal they're involved in, but also within the companies themselves, they really understand that employees and retention of employees is the key to maintain a low risk across the portfolio. And risk is very important to them. And so they take that approach to the balance sheet. He talks about their leverage ratio and how they use real estate to have real collateral. And then also I would say deal screening. They are very particular about the exact size and type of business they buy. And so because he is so deliberate and his buy box and operating model is so defined, sure, your fishnet is not so wide, but the power behind what you're actually doing becomes that much greater. And so he speaks with a lot of credibility.
To your point about the risk, Ryan calls himself somebody who is very conservative. So de-risking is a key feature of the entire structure of North Park Group, which is maybe a little counterintuitive at first blush because these businesses are all acquired with SBA loans. As everyone knows, SBA loans require personal guarantees, very high risk, and they have figured out a way to de-risk personally guaranteed business acquisitions, partly from what you said, Nicholas, the acquisition of real estate, high equity into each deal. 50-50 is generally the ratio. And so they get but at the same time, they get the benefit of the SBA. And what that is, of course, is the long amortization, particularly if there's real estate involved because of the equity that goes into the deals. So there's a lot of cash flow that comes out of these acquisitions. And despite being a risk-averse person with a portfolio of SBA acquired businesses, Ryan says that he sleeps completely soundly every night. So to see a holdco, if you will, built with SBA acquisitions, but also be so de-risked, even with 5 personal guarantees in there, was really interesting. I mean, it really goes to, as you said, Nicholas, the thoughtfulness that they put into this structure. On the on what they've been able to take from the independent sponsor model, it would be the word that we always hear, flexibility. So they do deals deal by deal. There's no pressure to deploy. They have eager investors, a wait list of investors. They raise the money up for a deal very quickly from this list that they've built over just 2 or 3 or 4 years, really. So there's no pressure to deploy. They can wait for their fat pitch. They can wait to find a business that pairs perfectly with the operating partner. Ryan talks about one of their partners wanting to buy a business in Chagrin Falls, Ohio only. So it took a little bit, but they did find one for that operating partner to settle down in his hometown of Chagrin Falls. That's not the sort of time flexibility that you're going to see very often. So flexibility combined with deal by deal, combined with SBA, combined with diversification. So as you touched on, Nicholas, the carry and how the operating partners don't have all of their eggs in the basket of the acquisition that they led, and instead the carry is spread across the entire portfolio, unlike your typical SBA searcher who has all of their eggs in the basket of the business they bought. That has been de-risked away. So a really a carefully and thoughtfully and well-crafted structure to North Park Group that has a lot of benefits from these models without a lot of the negatives. Pretty impressive. I have to say I'm quite a fan of it. So it was great to have Ryan back on.
Yeah, that was a fun one. And let me just emphasize one more thing that I think both of us briefly mentioned there. But they buy the real estate. They specifically look for companies where there's real estate associated with it. And of course, in private equity, you typically don't want to buy real estate. You're a business buyer. And to the extent you have to buy it because the seller demands it, you're going to use a sale-leaseback option or do it as a completely different structure. But in this case, they cross-collateralize, which lowers the risk of the PG because it's largely backed by the real estate. They're owning them indefinitely, so it makes sense to own the real estate. And I think we see on this podcast that some of the most successful people have found some hair with a deal that isn't your standard private equity playbook, but that they are attracted to as opposed to repelled by. And in this case, one aspect at least that Ryan Sullivan and the others are in North Park are attracted to is the existence an opportunity to buy real estate. So very well thought through again.
One other thing that comes to mind, I'll just say about on the SBA point, we'll see structures out there where the SBA loan is used for its favorable leverage characteristics, and it's kind of used sometimes aggressively for reasons of financial engineering that really a private equity person would be able to do, but isn't actually in the spirit of what the SBA is trying to do, which is enable the transference, the succession of these small businesses. And here at North Park Group, they are using the SBA in the way that it was conceived, in the spirit of the SBA, because they are long-term holders, because they aren't trying to, do some sort of roll-up that will then be exited to a future buyer. It really is about protecting the businesses, protecting the jobs, and keeping those local businesses in their communities over the long term, which is precisely what the SBA is designed to do. So interesting to encounter somebody who is kind of sort of doing private equity with SBA, but still keeping to the spirit of the SBA.
I hadn't thought about that because I often think about how a lot of people kind of exploit the SBA 7A program. Private equity wasn't really the intention of it, right?
Right.
But in Ryan's case, it's more aligned with what you think the politicians initially intended. And then I think he also speaks very carefully to how debt, there is a fine balance. Is debt leverage or is it a liability? It can be either, right? And you got to be careful to use it in a way where it's leverage and not a liability.
Great. Well, before we get to Ryan Sullivan, a reminder that Minds Capital is actively investing equity in independent sponsor deals. So please reach out to us if you are a sponsor with a live deal, mindscapital.co. And if you are interested in investing in Minds Capital as an LP, we actually have a fundraise underway, Flagship 2. So if you're interested in learning more about that, there's a form on our website, mindscapital.co, that you can fill out, and we will be in touch. Okay, here is episode 37 of the Minds Capital podcast with Ryan Sullivan of North Park Group. Enjoy. Welcome to the Minds Capital Podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Chicago-based Ryan Sullivan and his North Park Group are serial acquirers of small businesses, $1 million EBITDA, call it, businesses, that they hold permanently. They use an operating partner model that is unusual. The operating partners become general partners. They take SBA loans and personally guarantee those loans. We're going to get into that. And NPG's focus is on manufacturing and industrial services businesses. To date, they've generated 25% returns on equity per year for their investors, and they maintain a wait list of investors who are always looking to get in their next deal. Ryan Sullivan, welcome to the Minds Capital podcast.
Thanks for having me.
Ryan, you and I first met last year. You were on the Acquiring Minds podcast, the sister podcast. That episode aired in August, so it's been well over a year since we connected. Can you give us and me an update on where North Park Group is today, a snapshot of the portfolio, please?
Sure. Yeah, I guess since I was on in August last year, we closed a bolt-on acquisition called Spill Stop, which one of our companies, Dickey Manufacturing in St. Charles, Illinois, actually acquired Spill Stop, and then we co-located those two businesses together. And then in January of 2025, we closed on an acquisition for Arcadia Glasshouse, which is a greenhouse business located out in Ohio. So we've done two other additional acquisitions since we last talked. So we're up to 5 kind of operating companies and 6 acquisitions since we formed. 5 operating companies, and I characterize those as $1 million in EBITDA. Is that pretty accurate? Is that kind of a good average? That's pretty accurate for our average. I mean, we typically buy between $500,000 and call it $2 million of EBITDA. So our average purchase is around the $1 million EBITDA mark. And then we buy both the business and the buildings. So, our typical deal value is a little bit north of what the just business acquisition would be.
Okay, great. So I mentioned the 25% return on equity without exits. This is a permanent hold or an indefinite hold model. There are a lot of interesting wrinkles to the model, and we're going to unpack all of them. Let's start with those returns. Can you give us the math on that, how that model yields those returns?
Sure. Yeah, I tell everybody I do math like a fifth grader, I guess. So we try to keep it simple. We calculate our returns for our investors, basically assuming that we could sell whatever we bought for what we bought it for. So if we buy a business for $4 million and a building for $2 million, we just assume that sometime in the future we could sell the combination for $6 million. So we don't do mark to market. We don't do appreciation of buildings or anything like that. And therefore, we calculate our returns as cash return to shareholders, cash on our balance sheet, and debt reduction, basically, since we've owned it. And based on that math, we run kind of mid-20s annualized returns for our investors. Some of it's cash back to the investor, some of it's debt reduction, and then some of it's cash sitting on the balance sheet of the businesses.
And those are great returns, especially without any liquidity events. How are you able to generate such returns?
We obviously buy good businesses and we buy well, right? I mean, I think in M&A, if you overpay, it limits your options as to what you can do to generate good returns. So we obviously buy well. We buy businesses that we know and understand. And then we're typically buying, what I'd call lifestyle, maybe aged out family businesses that have been run by somebody for 40 years who haven't tried to grow, right? They've grown to a point. They ran a very good business. They took care of their employees. They took care of the communities they were in, but they stopped trying to expand the business. And so when we get in there, we can freshen up the business. I kind of jokingly say we take businesses from the year 2000 to the year 2020, right? I don't necessarily want to pay to bring them to 2025, but it's nice to bring them to 2020. And when we do that, we tend to find efficiencies, we tend to find growth, we tend to find ways that the business can make more money, both kind of top line and bottom line.
Well, that sounds like a pretty familiar playbook. Get in there and find the levers, find the low-hanging fruit, do some professionalization, turn growth back on. So is it, you said you buy well, but is it also in to the aforementioned SBA loans and kind of the leverage profiles that you're able to generate returns, again, just cash coming out of the businesses?
Yeah, we under lever our businesses a bit, right? So I'm very risk averse. We talked about that a lot on the first podcast, right? I'm an engineer, so I'm like, everything to me is just basically risk and downside. So we typically are 50% debt, 50% equity, including the building. So that leaves a lot of free cash flow in the business, right? And that free cash flow in the business enables us to do things like invest in new machinery, right? Or put additional CapEx into the business post-acquisition, hire additional people, right? That when that free cash flow gives you a lot of optionality in business. And so unlike kind of a lot of your typical maybe ETA or first-time buyers doing SBA loans that are like a 1090, well, in those models, there's not a lot of free cash flow depending on what happens with the business after debt service. I mean, even on a 10-year amortization, 90% debt on a business is a lot, right? Mm-hmm. So the fact that we use investor money de-risks the acquisition. We own the real estate, so that de-risks the acquisition. That means we're basically paying rent to ourselves. We don't have escalating rent payments every year. I mean, we do up it to keep the books straight, but it's circular, right? It's rent coming back to us. And that leaves us a lot of free cash flow. That free cash flow gives us the ability to do a lot of things in the business that a lot of people that are maybe bootstrapped can't do in small businesses.
Can you walk us through the math of what the typical deal looks like here? I think we heard you say 1 million of EBITDA, and then you also say you're building or buying the building. So what does the sources and uses look like on a typical deal?
So if you take a $1 million EBITDA business, let's say we buy it for 4x, right? That'd be kind of typical in that range. And our EBITDA is true EBITDA. It's not SDE, right? So that includes a salary for a business president or CEO. Typical building, call it $1.5 million. So you've got, $5.5 million of purchase consideration. And then typical transaction costs, call it $500,000. So legal fees, building appraisals, phase one, bank fees, all that kind of good stuff. Buying is expensive, selling is expensive. So that gets you to a total purchase price of $6 million. In a deal like that, we would typically be $3 million in equity, $3 million in debt. Some of that debt's against the building, some of that debt's against the business. We've done both a blended and separate 7A 504s. But that really de-risks the acquisition, where now you've got $3 million, where say a part of it's on a 25-year building loan, part of it's on a 10-year SBA loan, better interest rates than you'd get obviously with commercial debt, better amortization. And that leaves a lot of free cash flow in that business. That's $1 million business. And these typically are not capital intensive businesses, meaning they have assets in them, they have equipment in them, but they don't require a lot of capital back into the business to keep the equipment running, right? There's not a high maintenance CapEx requirement. Their machines might be from World War I, but they'll run for another 50 years, right? So there is a good asset base in the business, but we're not having to buy $1 million machines every year to keep the business running, right? So that typically means our free cash flow to EBITDA pre-debt service is like 80%, 85%, right? And so when you take the debt service off, you've got typically kind of 20%, free cash flow coming off the business relative to your EBITDA number. That then again,
okay, so let me stop you there. So out of the 1 million, you're saying about 20% of it goes towards CapEx and reinvesting in the business, right? The D&A and the EBITDA, if you will. And then another, give or take, $500,000 that goes towards debt service. But that leaves you with $250,000 for each of these assets that is free cash flow on an annual basis.
Correct.
How much of that is taxed?
Well, we're all LLCs, so the tax is going back to our investors as a pass-through. But that's the cash that we're available to reinvest in the business for growth CapEx, distribute to shareholders. That's the free cash flow that we can operate the business off of that gives us optionality as to what we want to go do.
And what is the benefit to you of having such a tightly defined buy box where, it's 4x on 1 million of EBITDA, it's with the building, so we can use this kind of debt. This is the debt to equity ratio. We typically buy manufacturing or facility heavy businesses, right? Explain the strategy there.
Yeah, I mean, we buy the businesses that we know and understand first and foremost. I spent my whole career in manufacturing, so that's why I tend to go after manufacturing businesses. If I feel like I can run all the machines and make the parts, I feel comfortable making the acquisition. We have other operating partners that have a different background than me, industrial distribution, building products. We have some people that have done, food service. So we're looking in other areas, but the key is aligning it with the operator's background. Most businesses we go after, we have somebody that has 15 years of experience in that industry, right? So that's important to us. And everyone always asks me, like, why don't you buy bigger businesses? Why don't you go after a $4 million EBITDA business? It's you make more money, it's bigger, you have more options. And I just say, I would, but this is just where I tend to win. For some reason, we tend to win in this $1 million space. I've bid on larger businesses, I just haven't won them, right? I've bid on smaller businesses and I haven't won them. So part of any good strategy, I guess, is understanding where you win and understanding where you don't win, and then spending your time where you win. And so we seem to be pretty successful in this space, both in the acquisition, but also in the operation, right? I mean, buying's hard, but once you own it, that's day one of, long-term hold. You're going to be in that business for 10 to 20 years. You better be good at the running it part, not just good at the buying it part. So our operators are the people that are in North Park Group, my partners, we're all very good at businesses this size and operating businesses like this.
So actually, Ryan, the SBA role here is not necessary to the model.
No.
It works because of the size of business you're buying, but it's not why you're buying sizes of that size.
Yeah, that's correct. I mean, initially we wanted, our investors like distributions, and so we would need bank debt that would allow distributions during the hold period for a lot of our investors, and the SBA allows that. Some commercial debt doesn't, does, a lot of it doesn't. A lot of the banks want the debt to get serviced first back to the debt service, and then 10-year amortization does give you a lot of optionality because of the free cash flow, whereas, normal commercial debt, if you're in 3 to 5 years, a lot more of your free cash flow is going to your normal debt service. But there are debt structures out there where you could do a bigger deal. And we've done pari passu. So we've done more than $5 million of SBA debt on a deal before. We bought one business that was probably 1.7 million of EBITDA. And then we followed up and bought a building for that business. So, we've done higher debt structures. There's ways to do that even with an SBA loan.
Mm-hmm. You mentioned operators. Who are your operators?
Yeah, well, I guess I'm one. Yeah, we run an unusual model. I mean, the way I try to explain it to people is we're the fund as well as the operators. If you think about a standard PE model, each one of us are people that historically have run businesses. We grew up in manufacturing or industrial distribution. We're all business operators. We didn't get here through the normal kind of PE route or the finance route or banking route. So we're people that have spent our careers inside of businesses. And so my partners are basically the operators. We buy a business. I've taken 2 of the personal guarantees. I have 3 other partners that have taken personal guarantees. And we go in, learn the business, operate the business, and then either continue to operate it or eventually hire somebody to operate that business. And so I've hired somebody to run the 2 businesses that I have personal guarantees against. My partner, Brian and Scott, still run their business. My other partner, Greg, has hired somebody to run his business. And so we run this model where as operators, we can get in there, learn the business, understand it, and then eventually bring in kind of whatever you want to call professional management to operate the business. And then we can go out and continue to look and acquire additional businesses.
And what does the ownership look like for all the partners?
Yeah, we structure our deals very much like a private equity deal. We ended up there because that's what our investors understood, right? And there's a lot of different models in the ETA space or the single acquirer space. We tried floating some of those when we were doing our first acquisition back in 2022. And a lot of the investors were like, I don't understand this, but all of them were invested in private equity deals. So they understood the kind of private equity model. So we run a 25% carry, which is basically our incentive equity. We charge a 10% of unadjusted EBITDA management fee. And then we obviously get a closing fee as well on the acquisitions. And so That's basically our incentive as the fund. And then everyone who takes the personal guarantee basically becomes a partner in the fund. So they share in that carry and that management fee across the entire portfolio. So I'm a big believer in diversification. We talked about that on the first podcast. Like, I could have gone out and bought, one good sized business or two good sized businesses and run them and try to do this by myself, right? I wanted to take the money I was putting to work and spread it across more companies to diversify. So to do that, I had to have partners. I had to believe in this idea of diversification and that 5 or 10 small businesses together are stronger than any one small business. And so as a result, I wanted to make sure that all the partners were diversified again. So unlike a normal private equity deal where the operator might have incentive equity in the business that they help the PE fund acquire, and they might have co-invested with that PE group, they're not diversified. They're typically not sharing in the management fee. They're not getting carry for the whole portfolio. They're getting just carry or incentive equity in the company that they're running, right? I didn't like that model inside of private equity. I wanted everybody to be in the same boat inside the portfolio. So our operators get a good chunk of incentive equity in the business that they help acquire. They take the personal guarantee and that they operate, but they also get carry and a portion of the management fee for the whole portfolio. So they get diversified across all the businesses that we currently have in the portfolio and everything we acquire in the future. So it's a much lower risk position for somebody who's acquiring a business to own and operate to be in than doing it solo and then honestly, there's upside relative to doing it with a standard PE model.
What about the PG? Is that somehow mitigated and diversified by the portfolio approach?
Yeah, not the actual risk, right? Because that would break the SBA rules, but we de-risk the personal guarantee basically by bringing in the equity, right? So if you think about the risk of a PG, the risk is really the debt level relative to the performance of the business. Well, at a 10-90, 10% equity, 90% debt, your risk is high. At 50-50, and it's 50-50 with the building, right? So our business debt is honestly probably down in the 30 or 40% range, right? If you looked at it just from a business transaction perspective, that hugely de-risks the personal guarantee, right? So when you look at our models compared to 90% SBA debt, and all of a sudden we got 50% SBA debt with a building and a business, call it, 35% business debt, on a business purchase, the risk of the PG is very, very small. I mean, I've taken 2 PGs. I sleep very, very well at night. No one's ever coming for any of my assets. Something very, very, very bad would have to happen to these businesses, not just a slowdown, not just a bump in the market. And so we de-risk the PG by having investors in there and balancing the cap table, which is the same thing that gives us a lot of optionality as to how we go grow our businesses. We reinvest a lot in our businesses, and we can do that because we set up the initial cap table with a lot of space. We can go out and do CapEx lines of credit. We can put additional debt on the business after we've bought it because we've left that headroom until we're in there and operating the business and really know and understand it. Instead of putting max leverage on it day one, then you get in there and you go, oh, I need a new piece of machinery. Where are you going to get the debt? Right? And so the fact that we de-lever at day one gives us the ability to make decisions after we know the business.
Ryan, how does the permanent hold, indefinite hold play into the model? That's sort of the third layer here, I think.
Yeah, I mean, it obviously changes the way we think about running the business, right? It's truly a marathon. We're not in a 3-year sprint. As a result, we like owning the buildings, right? Because if we're going to be there for 20, 30 years, why pay rent to somebody else? Why buy your building 2 or 3 times? We reinvest in our businesses. We like doing CapEx. We like buying new pieces of equipment because we're going to own the business for 10 or 15 years. The big thing there was making sure that investors were aligned with what we wanted to do. I don't have investors calling me and saying, when are we going to exit? Hey, things are looking great. Should you sell? Like, no one ever calls, right? They get their distributions. They love our philosophy as much as our returns. And it was a big part about making sure that sellers understood how we were going to treat their business, how we were going to take care of their business. We weren't there to run it for 3 years and sell it to somebody else. We're there to take care of the legacy of the business and take care of the employees that are in it. All right. So it's a philosophical thing as much as anything. Now, I tell everybody, if somebody called me and offered me 15x for one of our businesses and I bought it at 4x, yes, at some point there is a financial decision, like we would sell.
Sure.
But the likelihood of that happening is low. So we say, hey, we're here for the long run. We're going to own these businesses until I tell everybody until I'm dead, and then the portfolio can figure out what they want to do with it. So.
And Ryan, your investors are retail, they're institutional?
Private investors, high net worth, they run the gamut. I mean, we started out friends and family, and then, people from our professional network, and now we've been introduced to other people. And then honestly, off of your podcast, I had people reach out and say, hey, I'd like to invest in your portfolio. So it started out where I knew 100% of our investors personally, and now I probably know 50% of our investors personally. And like you said, kicking it off, and we have a wait list of 40 or 50 people that are just waiting for space in the next deal. We always let our current investors invest first. We basically give them a week to commit. And then after that, we go out to our wait list, and then we're usually full on our deals by kind of week 2, which is why we tell sellers, hey, we're fully funded. We have no debate about raising the equity we want for a deal. It's just a question of what the mix is.
And the fact that that all of your investors are signed up for this kind of patient capital approach, I guess you've kind of filtered for that.
Yeah, we filter, I guess, really on 3 things. We filter on long-term hold, right? So we're not interested in people who want to be in and then want to be out in kind of 4 years. We filter on people who want to be diversified, so we want our investors to invest in every company that we acquire. Our investors don't really cherry pick which deal they're doing. Like I send the book out and they're like, yep, I'm in again. Like they haven't even read it sometimes. Like I get a response in like 5 minutes, like you didn't read a 30-page investment book in 5 minutes, right? And then they believe in our philosophy, right? So it's not purely financial return. Like we renovate our buildings. We've moved buildings. Phoenix Electric we bought, and it was right near Wrigley Field. I think I told this story maybe on the first podcast. We had to buy a building and move. And we could have gone to Wisconsin. We could have gone to Mexico, right? Like the pure financial decision would have been Indiana, Wisconsin, or Mexico. We didn't. We moved into a building that reduced the average commute time of all of our employees in the city of Chicago. Bought that building, renovated it with a TIF grant, which means it wasn't necessarily in a great neighborhood. So the city helped and moved in there. And now we have a building that's 10 times better than the building we were in before. We own it. We renovated it. Looks great. Well, obviously, we're going to get a lower financial return than some of the alternatives we could have done. So our philosophy is about taking care of the people, the communities, the business, and investors. And so we filter our investors on those 3 things. They have to want to be in it for the long term. They have to want to be diversified, and they have to believe in our philosophy about operating small businesses.
And just, Ryan, on this philosophical point, this ethos that you have of protecting local jobs and kind of reinvesting in the community, where does that come from? Why that ethos?
Oh, well, I don't know. That's a good
personal
question.
Experience. I mean,
I tell everybody I got really lucky in my career in a weird way, which is I was in telecoms during the telecom bust. Right. So I was working for a company that went through 7 rounds of layoffs, and I saw a lot of people lose their jobs. And that was great for me at the time because I survived like 7 rounds of layoffs, and I just kept raising my hand because you end up in a room and they're like, who's going to do Mary's job? Who's going to do Bob's job? And I'd be like, I'll do it because I wanted to keep my job. So I got really a lot of good business experience living through a market crash. And then I left telecoms. I went into building products because I was like, hey, building products looks great, looks really stable. And that would have been like 2004. Right. So then I lived through the housing market crash, and there I was shutting plants down, and you're letting go 100 hourly workers who they didn't do anything wrong. These are great people doing good work, doing everything you ever asked for them. They all lost their jobs, right? Because of a market change, or because of the way a company was run, or decisions management made. And so I think that left an impact on me about the responsibility that comes with owning and operating a business. Yes, you're trying to drive a financial return, but we have 300 people, say now, inside of the North Park Group companies. We have a huge responsibility to those 300 people because their livelihood depends on us. It depends on the decisions that we make. And yeah, we need them. We need them to do good work, but we have a huge responsibility to them. And so I think living through all those market crashes and having to make really hard management decisions and life decisions probably formed my desire to take care and foster these companies and the communities they're in.
Ryan, you said 300 employees in total. Can you give us the aggregate revenue number across all the platforms?
Yeah, I mean, we're probably on a run rate of like 60 million now across our 5 companies. And we average about a 10% EBITDA number. So on a go forward basis, we're probably in the 6 million EBITDA range across the 5 companies.
Great. Thank you. And so when you started this, you started it with this vision fully baked, and then you brought in all these operating partners.
Oh,
I
hell
mean,
no.
at the top,
Yeah, no.
is it? No, okay.
I'm not that smart. No. I mean, my partner Greg and I started it, and I was running a portfolio. I left that portfolio. Greg convinced me to form North Park Group and that we could fundraise. And so, well, we got to buy at least 3 or 4 to make this thing sustainable. And we just started buying. And so the partnership structure, started out day one with, Greg and I at 50-50. We didn't know any better. We bought our first company. He ran it because I had a severance and, he was unemployed. So he took the first one and he took the personal guarantee in the second one and I ran that one. And then we got into 3, 4, 5, 6 acquisitions, and the model honestly has changed a little bit each time. The investors have stayed the same. The investor structure has stayed the same, but how we run the group, I think, has changed. And I think that's maybe been one of our strengths is that the partners we have been very aligned with kind of the vision, the philosophy, and this also idea of long-term value, both personal and business value, has done very well inside of our portfolio.
What were you doing wrong, in quotes, for those first couple acquisitions that you've refined and have improved now?
It's really, I guess, how the partnership works or split stuff, right? We always had this idea that there's a whole bunch of work that has to get done and to run a portfolio, to run an operating company. And so we're constantly trying to balance the work that's getting done by different people versus the sharing that we do across the portfolio. And it's interesting because it's as much personal choice as it is decisions inside the portfolio, right? So we're, if you think about the 4 partners we have, my partner Greg, me, Brian, and Scott, we all have different life goals. We're all in a very different spot in our lives, right? Scott's a little bit older than me. We call him Grandpa. Scott wants to run his business. He's having fun. He's killing it. He's doing a really good job. He could probably care less whether we go buy 4 or 5 more businesses. He's super happy doing what he's doing. He's good, right? Brian in Ohio, he's like a few months older than me, which means I always get to say that he's older than I am. He's doing great running Arcadia, but he wants us, for his family, for where he is in life, for what he wants to accomplish. He wants to see us go buy 4 or 5 more companies. And the portfolio works for both of those guys, right? It works great for Scott. If we go buy 4 more, Scott gets a little piece. He's super happy and he loves it and the capabilities grow and that's interesting to him intellectually. And then if Brian wants to go do all the work to help us buy 4 more companies, then he's going to get a bigger piece, right?
By actually being the partner in those subsequent acquisitions, he would lead each of those. By doing the work,
by finding the deal, by dealing with the investors, by taking another PG, by helping operate the company, right? So we're figuring that out. It's great to see a portfolio where you don't have to have everybody who wants the same thing.
Yeah,
different people want different things because they're in different phases of their life. We have Caleb, who runs our business down Electron, hasn't done a personal guarantee yet, but wants to. We hired him as an operator. He loves our model. He wants to take a personal guarantee. He wants to get his own business. He's 30-ish, 30 and change. He'd like to see us buy 20, right? So he's looking at this model thinking, geez, I'm 30. If we did, 4 companies a year for the next 20 years, this thing could be huge. And he's in day one, right? So the portfolio works for all those people. And we just try to make sure that the rewards are going to the people who are, bleeding from the eyeballs doing the work. And so that changes also as where people are in their life change. I've been honest with everybody. I'm like, hey, I'm coasting down. I'm not trying to ramp up. I'm 52 and I like my life. You know what I mean? Like I'm good. And there's guys that want to ramp up like Brian and Caleb and stuff like that. So we're trying to make sure that they're incentivized to do that and that we all get to participate and we're all having fun.
You mentioned that you maintain an investor list that you keep building and adding to. What are the dynamics or day-to-day activities that revolve around having a retail investor list? How do you add on to it? How do you filter? You talked a little bit about it. And how do you keep in touch with them and keep them warm so that they do in fact reply within 5 minutes when you send the next deal?
Yeah, I guess all of our current investors get a quarterly report out of each of the businesses that they're invested in. We give them P&L, balance sheet, a management write-up on it. So we do that quarterly so that they see the results. We pay, distributions kind of once, twice, sometimes 3 times a year. So it's a good way to stay warm with investors is when you send them a check. We do sometimes try to time our distributions to be before we're doing a fundraise for a new acquisition. So we're like, hey, we're under LOI, time to kick out a distribution, remind them, and then get them all to invest in the next one. And then we do a bit of an annual report to people that are on our wait list. And honestly, things like this. I mean, I try to be pretty active on LinkedIn. We post when we do distributions from our portfolio. And so all of our investors follow me, and everyone on the wait list follows me. And so they get to see kind of North Park Group news. We have them all in HubSpot, so we can do email blasts to tell them what's going on in the portfolio. And we're not a PE fund, right? We don't have to buy, right? So we closed one in January of 2025. We're not under LOI right now, so we're not going to close another one in 2025. In 2023 we didn't close anything, right? So we buy when we find a good company to buy, where we have a good operating partner. Where all the stars align. And so a lot of times guys will reach out and be like, are you going to buy something? I'm like, hey, we're trying. I've bid on a lot of stuff this year. I just haven't won.
What's your approach to deal sourcing, and how does your funnel look? Do you have the numbers when you say you've looked at a lot of stuff?
Yeah. We source like everybody else. We have a buy-side broker who's out cold calling, looking for proprietary deals.
How is he compensated?
Success fee. Well, there's a monthly fee and then a success fee.
And the monthly fee is, give or take $5,000 a month then? Or?
Yeah, that's right.
Yeah.
That's right. So yeah, she's great. She's doing good work. I mean, she probably gets us 2 to 3 intros a week, basically, from companies.
If she's getting you that amount of warm introductions, and you guys have this very, I would say, pretty owner-friendly. Everyone talks about protecting legacy, but it's really credible in your case. And there aren't that many buyers. I mean, you're buying small, so there are a lot less buyers for the businesses that you're looking at than if they were $2 and $3 and $4 million of EBITDA. So I'm actually surprised that you're not winning as often. And you buy for what seems like a kind of a normal kind of 4x.
It's a fair price.
Exactly. So what do you think it is?
I'd say 50% of the time we're not losing to somebody else. They're just not selling yet. And I think that's very normal, especially if you're buying at a 4x ratio. The math lots of times is the incentive is to hold the business and continue to operate it. Right.
Yeah.
So if you're talking to somebody who's 55 and they have a business and they're interested in maybe getting liquidity and the going market value is 4x for that business, it makes sense for them to hold it for a few years. So, I'd say at least 50% of the time we're bidding on something, the seller's just deciding not to sell. And that's totally okay. I view those as great conversations, and I tell all of them, hey, I totally get it. I understand. If I was in their position, I probably wouldn't sell either, right?
And so what do you do then?
I just tell them to make sure I'm the first call. I'd say, I want to be the first call when you change your mind and you're really ready to get out, right?
But do you touch base with them? How often would you touch base with them?
Yeah, we try to stay warm. I mean, every 6 months, we try to ping them, right? Because there's no point trying to hit somebody once a month when they're, depending where they are in the cycle. And again, that's part of why we're active on social media. That's probably why I go to conferences. It's why we do things like this, is to remind people. We just want to be the first phone call when they finally decide. I mean, all these businesses are going to transact at some point. All the businesses inside of North Park Group are going to transact again at some point. It might be 30 years, but at some point, every business is going to transition. And we know we're good owners. We know we're good stewards of businesses. So we just want to be on people's call list. And honestly, that's how we got Phoenix Electric. Phoenix Electric, we tried to buy 2 or 3 years earlier from a different portfolio. And then they called us back and they had our cell phone number and they said, hey, we're now interested in selling. And so, we bought Phoenix Electric in 2022, but I think we reached out to them in 2019 the first time. So sometimes it's a very long cycle, depending on somebody's decision to sell. I mean, it's a huge decision to sell your personal business that you've run for 30 or 40 years. I mean, it's almost an unimaginable decision. So yeah, at least 50% of the time, Will, I think we're it's not that we're losing, it's just that they're deciding not to sell. The economics just don't necessarily work out for them. And then, the other 50% of the time is split between it's a business that turns out that it's not the right fit for us. It's too small, or, we find a lot of businesses that have, 8 people in them and the sellers, doing 70% of the work. And that's just not a good fit for our model, And so obviously there's a big filter there where we lose a lot of the things from our funnel just based on how we filter them out.
What does the funnel look like?
Like I said, we're on Axial. We have a buy-side broker. We're on Axial Generational Equity. We get a lot of books from bankers and stuff like that. We have a pretty good network at this point. I would easily talk to 100 companies a year off of books and introductions. And so that's kind of a normal ratio for me, is probably 100 conversations to lead to kind of one acquisition, type of thing. And you typically lose 50 of them right on the first filter. You look at the book, you look at the location, or you look at the size of the business, and then you whittle down. And I probably only do 5 to 8 LOIs a year, and so those are the ones that you're actually really bidding and losing. And we probably do, 15 or 20 indications of interest. And then, those ones that don't go to the next phase, a lot of times they don't go to the next phase because, again, the seller's just looking at your range going, I'm not going to sell. You know what I mean? Yeah. It's not that they went with somebody else. And I think that's pretty normal in this space,
When and how do you test the waters on valuation? You're pretty disciplined. Not to say you're a value investor, but you buy 1 million EBITDA companies, give or take 4x. So how does that work? Like the actual semantics of landing a valuation?
Yeah, I try to do it early. I tell everybody I want to be sensitive to my time and then the seller's time, right? Like you can't put hours and hours into it to then realize that a business you're trying to buy for 5 million, somebody wants 10 million for, right? And so we usually get introduced, trying to understand the business, understand the size of the business, get some preliminary financials. And then we'll do a range, right? We'll do a range for the business and the building. And I tell them, like, hey, I could be way off, but like this is my initial range. And, I'd say half the time they're like, yeah, that's the range I expected. Let's now do more work. Or they're like, oh, you're way off. And then I usually just ask them a few questions like, well, okay, this is what I have as your EBITDA. Like, why am I way off? Right. And, I'd say 20% of the time we missed something in the financials. They were kicking out distributions that we thought were an expense and not, an add back or something like that. And so we adjust our range and maybe we're close, right? But I try to do that very early on after just 2 or 3 conversations, usually even sometimes before I'd go visit a business, just to try to make sure if it's worth getting on a plane, flying somewhere, because we're not buying everything in the Chicago area. We're buying stuff all over the place. If I hopped on a flight every time a business owner said they were interested in selling, I'd be traveling nonstop, right? So we usually like to see financials and give them a range before we go visit. And then if we're in the ballpark, then we spend the time to visit. And then we do a lot of work, like pre-LOI. We've basically done what most people do is diligence post-LOI. Like we do a lot of work. Like once we sign an LOI, like that deal's done. Like it's going to close. Like we've done HR, we've done everything other than like the building inspections and phase 1s. We do a lot of work pre-LOI. So when we sign an LOI, I want all the negotiation to be done. The consulting agreement's done. All the terms of the deal are done.
Isn't there quite a bit of risk to do all that labor and probably expenses also the vendors before you have exclusivity?
No, we don't use outside vendors. We do it all ourselves. And then after LOI, we would use our outside accountant to do financial diligence and stuff like that. But we've done a lot of it ourselves. Like we already know. It's expensive from a personal time perspective, but it's not expensive from a dollars perspective. I view it as lower risk than signing an LOI and then paying lawyers and accountants and everybody in there and then realize all of a sudden the deal has to change. And the minute you try to change a deal after an LOI, you've put yourself in a position with a seller where trust gets diminished, right? Because hey, I'm going to buy your business for $5 million. And then you go and, hey, we did some financial diligence and guess what? We actually can only buy your business for 4.2. Like, that's just not a fun conversation, right? So we try to make sure that like we close per the LOI and we don't retrade, which means we have to do work up front to make sure we're not going to retrade. Because a lot of these sellers have been around the block with somebody else who retraded and the deal fell through. And, even if they were running a proprietary process, we just don't want to do that. Once we send an LOI, that deal to me is as good as done, unless the seller changes their mind, which still happens, honestly.
This is where your own expertise in manufacturing and understanding these businesses deeply comes into play, that you can do the diligence internally. You can do it pre-LOI.
Yep. Yeah. I mean, these are businesses we know and understand, and we have enough people in our portfolio now that we can do the work. We can do a level of financial diligence, HR diligence. We can look at the assets and understand the equipment. We have banking partners. We have real estate partners that'll do some work in advance. And so we know we can fund it, and we know we can get the debt structure we want all before signing the LOI.
Mm-hmm.
But all the more questions around the whole model of yours, which is you've done 5 platforms, 1 million each. That's 5 times this huge workload, of which you even put it before exclusivity, where other sponsors will do one deal at 7 million of EBITDA and put even more capital to work and have a bigger swing, so to speak. But so how do you think about that?
Yeah, everyone tells me I should do bigger deals. Yeah, I mean, I don't know. These are the companies we like. It's a model we like. These are the types of companies we like to run. They're also the types we know we can easily fund. And a lot of it is also, you talk about taking money, right? If I did a deal at 5 million of EBITDA, and that deal is going to go more for like 5 or 6x, and that's $30 million. I don't know that our investor base could raise us, $15 or $20 million for a deal, and then you're into commercial debt. It's just a completely different model. And when you go that model, I think you also end up with a different level of control, right? So as an independent sponsor, you do that deal, you don't necessarily always end up with control, right? Because usually whoever brings the $20 million of that deal, has an awful big say in what happens to that business for the next, 5, 10, 15 years. A lot of this we're doing because this is what we want to do, right?
Yeah.
It's not necessarily about how much money can we make or the straight financials. We're doing this because we're business operators and we wanted to buy businesses to own and operate them. And we're more like ETA people than we are private equity people, right? It's more about, if you go see Scott, Scott's loving life. And why is he loving life? It's because he's running his business every day and he's got control, and he sleeps really well at night because he didn't have 90% debt on it, right? So like we're all guys who otherwise would have done the ETA 1090 deal and instead did it as part of North Park Group because we could de-risk what we were doing and still have that like owner, control, operator side of our lives. This is what we get to spend our days running a business that we own and operate and feel like we are the owners, right? And so it was a way to do the ETA model with a lot less risk, right? And you don't see a ton of ETA people going out buying $7 million EBITDA businesses, right? And so we can buy a slightly larger business, which de-risks it, right? So we're not down in the 250, 500 range a lot. We're not dealing in SDE, we're dealing in true EBITDA. So we can buy slightly larger businesses than a normal ETA person could maybe afford if they were doing it on their own. And we're de-risking it with outside investor money. And we get to do what we really wanted to do in life, which is run manufacturing and industrial distribution businesses and hold them for a long term and have control, right? Scott can't get fired. Brian can't get fired. They have control. They get to decide how they want to run their business. It's what most of us personally really wanted to do in life. It's not always a financial decision.
Well put, Ryan. Love it.
Thank you. I thought of all that on the fly too. I was sweating a little bit there for a second.
Where does it take you then? You're doing what you love, and you found a model that works. And these are small deal, yes, but you can go big by going small repeatedly, right? So where does that take you in 5 or 10 years?
Yeah, I'll tell everybody it'll take us wherever we want to go, right? Brian wants us to buy 4 or 5 more, and if Brian does the work and Brian's successful, we'll buy 4 or 5 more. Scott's happy, right? the model has a ton of flexibility to go do whatever we'd like to go do as a group or as individuals for the next 5 to 10 years. And I think that's why it's so exciting. Financially, like we're all okay. Like we're good. If we don't buy another business, I think everybody's happy. Right. And I think, we also could go buy 20 more under this model, and it'd be good for everybody in the portfolio and good for our companies if we bought 20 more. I tell everybody, I'll buy every good business I find that is for the right number, that I have a good operator for. Like we're not really limited. If anything, we're limited by the number of vacations I take, or how much time I want to spend with my wife.
How many vacations do you take?
Yeah, I take a good bit of vacations. We're probably good 3 vacations a year. And that comes with, that's why we did what we did, right? Like we're all business owners. We operate our businesses. We set our businesses up where they don't rely on us 100%. Even Scott can take a vacation. He's part of a portfolio. If Scott wanted to disappear for 4 weeks, I'd go spend 2 weeks in Memphis and he'd be fine. You know what I mean? So that's part of why we're part of a family. There's a lot of coverage. There's no single point of failure in our network. And that leads to a lot of personal flexibility, right? Like I said, it's not all a math equation. Brian wanted to live in Chagrin Falls, Ohio, where he grew up because he's raising his kids. He now bought a business where he gets to live in Chagrin Falls, Ohio, right? So there's like the ETA path, or the buying a business to own and operate a path. There's just as much there about how you want to live your life and how you want to do your work every day as there is about a financial decision. And that fits very well inside of North Park.
Ryan, we've talked about your wait list of investors. We've talked about your deal sourcing. What about partner sourcing? Where are you finding your operating partners?
Yeah, I guess it's a mix, kind of like looking for companies to buy. We obviously have people that work in our portfolio today that are interested in being operating partners. So taking the personal guarantee, acquiring a business. So these are people that we've hired, or people that were in the businesses that we acquired, right? And then looked at our model and said, hey, I actually want to go do that. So some of our sources of future partners is internal. And then, just like, I guess both Brian and Scott, they were external. They were people that either I knew from my network or got introduced to North Park Group that said, hey, we want to buy a business. And they decided buying that business was better for them under the North Park Group model than buying it on their own. And so sometimes that's a deal that we source and we know an operator and we put those two things together. Or there's an operator that has a deal and potentially brings it to North Park and says, hey, I have a deal. I'm looking at buying this thing on my own. I'd rather kind of de-risk it and maybe buy it as part of North Park than buying it under the 1090 SBA model. And so we're trying to do all of those different scenarios. Because the idea is that, people have to believe in the North Park Group philosophy. So they have to believe in diversification, they have to believe in risk reduction, and they have to believe that operating a company inside of a family of other companies is how they really want to operate, right? There's a lot of people out there at ETA, they're like, no, I want to do this all myself. I want to own 100%. And I don't want to go at my own. Awesome. That's a great model. It just doesn't fit North Park Group. And then there's a lot of people that are like, hey, 90% debt on this business and a personal guarantee seems super risky. And that's why a lot of people don't buy a business. They don't buy a business because they pull back. They short arm the company they're trying to buy. I mean, I think 90% of the people looking to buy a business don't ever buy one. And it's because they short arm it because they view it as super risky. And so underneath North Park, we de-risk it so more people are willing to actually take that leap and still end up with control. They still get to operate their business. They still get a lot of the life benefits that they wanted to in the idea of acquiring a business. And
how much equity do they have to bring to put into the deal?
They don't have to bring much of anything. We have people that have put $10,000 or $20,000 into a deal because we can bring all the equity for a deal. Now, their equity ownership aligns with the amount of money that they bring, but their upside really is the incentive equity and the management fee that they get, and then the idea that they're operating inside of the portfolio.
It's a pretty good deal. Do you have a list of operators who are eager to get in?
We do. Yeah, we have a bunch of people who we're working with. I mean, some of them is like Brian. Brian and I probably worked together for a year and a half because he wanted to buy a business in Chagrin Falls, Ohio. It took a while for us to find one. He was looking, I was looking. I don't know who actually found Arcadia, but and so, yeah, we have people that we're looking for a specific business for certain people. We're just looking for businesses, and then we blast it out to a network saying, hey, we got a business in, Idaho. Is anyone interested in actually living in Idaho? All right, because you obviously need the operator who wants to live there and be part of that business. Yeah. And we have people internally that we're looking for. We just bid on a Five Guys franchise, 8-store location thing, because we have a partner inside of the business who has 20 years experience in the restaurant industry, and so that aligns with his background. So again, we're branching out because it's all about matching the operator's expertise with the business that you're going to buy, and then it's got to match the location, it's got to match what they want to do in life. There's a lot of stars that have to align.
Can you really quickly walk us through the Arcadia deal, just as kind of a snapshot case study?
So Arcadia was probably $800,000 in EBITDA. We acquired it for, call it 4x, keep the math simple. We bought the building, right? So I think the total transaction was, maybe $5.5 million. There was a seller note that we did in there because we had a performance-based seller note to de-risk the deal a little bit. And then we did a blended 7A504 for the building, which gave us really long amortization on the debt. So a lot of free cash flow off that business, which is great. Brian brought, I think, $50,000 of the equity in that deal, and the total equity in the deal is, call it, $2 million, give or take. So I can probably find the number here real quick just to actually give you the right number.
And the business, what does it do?
Million. 2.8 million. Arcadia makes greenhouses. Yeah, residential and commercial greenhouses. So the total equity in the deal was 2.8 million. Brian, I think, brought 50. So the rest of the investors, including North Park Group people, brought the 2.7 million and change of equity. Initial debt on that acquisition, including the building, was 2.2 million. So it was right around whatever, 5 million deal. Brian got 30% of the 25% carry in that business. Right, so he got 7.5% incentive equity plus the equity he put in. And then he got 0.5% of equity in every other company that we own, and then he'll get 0.5% equity in every company that we acquire. All right, so again, the diversification idea. He gets a bunch in Arcadia that he buys, but he gets a little bit in all these other companies inside the portfolio. And then he's getting 40% of the equivalent management fee coming off of Arcadia. Again, blended, so it gets blended into the North Park Group management fee. So it's diversified. So even if Arcadia doesn't grow, but the rest of the portfolio grows, his management fee goes up because he's diversified. So diversification goes through everything that we do. And then he's obviously pulling a salary, and he's got a bonus program and all that kind of stuff because he's the operator of the business as well. So he's an equity owner. He's got incentive equity. He's basically in the fund, and he's the operator. He's all three things in the PE model. He's the investor, the PE fund, and the operator.
Appreciate that, Ryan. That was great visibility into this. Well, there's much more to say, but we got to let you go. But thanks for coming on and sharing again about North Park Group, Ryan. It's a really unusual model. I mean, I hadn't found anything like it when we talked the first time, and I sure haven't since. Kind of a tweener, I think, as you called it.
Yep.
That's excellent. Really, yeah, really.
I view that as a compliment. Well, I appreciate it.
So thanks a lot, Ryan Sullivan, and we'll have your LinkedIn there, of course, the URL. So for people who are interested in any of the above that we've talked about, even as potential operators, I guess they can reach out to you that way.
That'd be great. Awesome. I appreciate it. And go Bills.
Thanks, Ryan.
Thanks. Cheers.
Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also, check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraises. See you in the next episode.